Now here's one that John was just kind of referring to. This is what we call the broken wing, or sometimes you might hear it called the skip strike butterfly. And the butterfly broken wing is very useful to speculate, on something, a stock, security, whatever, that's kind of been, stagnant to either slightly bullish or it could be bearish, depending on, your kind of bias to the market, what you're looking at. But let's say you're confident that if it breaks out, it's going to, go to only a certain direction. So if you're very confident on a directional move, either maybe to the upside or maybe to the downside, you can then set up a trade that we call the broken wing or skip strike butterfly to lower your cost, okay, of the trade, but give you a big potential payoff, but really lowering your cost to very, very little by skipping strikes, okay? And so this is simply a butterfly spread where the risk is then inclined to one side. So either you're bullish, then we can structure it to reduce our risk to the downside, but keep us, potential big upside return, or if you're bearish, reduce the risk to the downside, etc. So the main purpose then is to adjust your risk profile of the regular butterfly to reduce the trade costs and give yourself a bigger return on that lower cost. So this is one that we had done on Microsoft. And so this was where Microsoft in this example was trading at $309.45. We were bullish, but and we didn't think it was going to go much higher. There was a big, area here, kind of resistance area that we're looking at 315. Okay, so it was trading at 309. We set this broken wing butterfly up, and then on the 17th, it was trading right here at 313 or 314 in that area. So this was one where we're bullish. We didn't think it was going to break to the upside, so we were able to skip strike the butterfly here, reduce our cost. And we were bullish on the upside, reduce our cost, and then had a lower cost trade. So you can see here was our price target. We were looking for that 315 target, and we were pretty confident. It's pretty confident that was a solid top target zone, that it probably was not going to get able to break through at this expiration. So we did the skip strike. So we went out and bought the 310 call, sold the 315 against it. So that's a $5 wide spread. See that? And then the other part of the trade was we set the 315 call short, but we widened out the other side of the spread to 322.5. So you can see that's a $7.50 wide spread. Okay, so we had a broken wing butterfly here. Now by doing that, we reduce our cost of the trade in this example to $85. Okay, so we had the skip strike on. We had then the potential, if we hit our profit target at expiration, to make $415 on that reduced risk of 85 or 85 cents per spread, or 85 bucks. So the spread width here was 500 on the debit spread side, less our cost 85. So potential to make 85 bucks, or $415 per spread on 85 bucks. That would be a 488% return. Risk $1 to make 488, but actually the potential risk though, since we did a skip strike, was that increases our potential loss here, you can see, was to 335. So there's no free lunch, but that's what I was saying. If you have an area where you think you're really confident it's not going to break through, in this example, we thought 315 was solid, wasn't going to break through. So we're willing to risk having that, for the lower cost. But if you're wrong, in this example, you would have lost 335 if it, just kept going up, something like that. All right, so that's the difference there. So let's take a look at what this looked like going out. So here's what the skip strike or broken wing butterfly looks like. You can see the spread here. Okay, so we've got here's the 310 right here. We're long this call here, the 310, short the 315. Okay, so there's your $5 wide spread there. But then we're short that 315 here, but we widen the spread out over here to make less cost. So the further out of the money, the less it costs to buy it, right? So that's the difference. You can see if we did a balance, it would look like right there. But we skipped a strike further out, reduced our cost to 85 bucks, and we had this going out right here, had a pretty decent profit. So it went from, we had the spread now was at 222 less our cost of 85. So we were up 137 bucks right here. Still had a bunch of potential profit in there, but that's 161% return. All right, so that was a pretty, that's a very selective trade for certain situations, and that's a pretty cool way to do it. So this was, a couple members, Gene, made 143%, and things like that. So these are for certain situations, but that's